the risks that could derail the Fed into what we expect them to do, announce and taper in November and then start tapering in December seems to be the line of sight. Take a look at Evergrande, you take a look at, say, these surging commodity prices in certain areas and power issues, you take a look at DC. What throws the Fed off course here?
Morning, Alex. I think there's a few things that could potentially derail the Fed. I mean, Michael was talking about the Fed's projections before, and we're actually tracking light on the Fed's growth projections for 2021, and we've revised our 3Q growth estimates down a few times in the last few weeks. We think it's only going to be temporary, but if it's more persistent, either related to the Delta variant or some of these supply shortages you've talked about, that's something that could derail the Fed tapering in December, particularly if it sort of slows the labor market. And I think that's the important point here. The Fed's acknowledged that it's made substantial progress toward its inflation goal, but it only made clear progress toward its labor market goals. So if we see another weak employment report at the beginning of October, where payroll growth slows once again and the unemployment rate doesn't decline, that's something that could certainly put it at risk. I think you could argue that the DC dynamics are a risk as well. I mean, it's clear that, or it seems likely that what's been presented by the House for the debt ceiling and the continuing resolution is unlikely to pass through the Senate. And we think at JPMorgan that this debate is likely to move on into October. But we do think that the risks of a technical default are pretty low. But I think those are the two things I can identify that could derail this from a November announcement.
We're light on growth, we're heavy on inflation. That seems to be the narrative that we're getting at the moment. Substantial further progress. We're not there yet, seems to be your suggestion.
Yeah, I think that's right, Guy. Certainly on inflation we are, but on the labor markets we're not. But we're getting there. And if the unemployment rate continues to decline, then that should put the Fed on a path to make an announcement in November. Even with everything that we've seen with the slowing in the economy over the course of the last month and the revision lower to growth forecasts, high-frequency indicators of the labor market, like jobless claims, have continued to trend lower, and I think are consistent with ongoing healing in the labor market. So if we see that continue, then we're on track for something in November, we think.
So it wouldn't take a lot, though, to shift one hike into 2022 and to move into 2023, and we're getting the first look at 2024. It wouldn't take that much. If we do get that, does the market take that as hawkish?
So it's funny, I mean, we've had all this discussion of taper, and we think that's less of an event than the dots. I do think that is on margin hawkish, Alex. The markets are pricing in about 100 basis points of tightening by the end of 24. If we're right and you see 6 hikes projected from the dots by the end of 24, that's 50 basis points more. So I think on margin that would be hawkish. That should result in higher Treasury yields, particularly in the intermediate sector as well, if we're right on that.
Jay, if the Fed decided to come out with news today and says, you know what, substantial further progress, we're there, we've made it, would that be risk positive or risk negative? The previous guests that we were hearing from on the tape were talking about their desire for a taper tantrum. If we were actually to get that announcement, would that be risk positive, though? Because it would signal that the Fed is pretty comfortable with where we are, not worried about the story in DC, not worried about the story in China, and as a result of which, we're in good shape. Would the market read it that way, or would it freak out?
Guy, I think that would certainly be a positive sign about what the Fed thinks about the current environment. But I think the bigger issue, and I'm just a humble rates guy, so I'm not a risk person per se, but if the Fed were to announce a taper today, I think the market would likely bring forward its expectation of rate hikes as well, because even though the Fed's done a good job of telling us that tapering asset purchases is something completely different from rate hikes, the guidance that they're giving us for both are the same. And I think we'd bring forward the liftoff date, and that would probably be somewhat negative for risk sentiment, all else equal, if we brought the first hike forward into late 2022 or somewhere around there.
Guy, you just said freak out. I feel like I'm rubbing off on you. It only took like almost 2 years.
Yeah, I'm not prepared to go as far as bananas at this point, but freak out I'm prepared to maybe talk about.
It's just a matter of time. He'll be cursing like a sailor. Okay, Jay, when you take a look at what the market is pricing, however, do we need to rethink where the neutral rate is and then how that winds up feeding through any kind of cap that you might see in yields?
At this point, Alex, we're not sure that there needs to be any change to the neutral rate. Certainly there are long-term structural dynamics, demographics, and productivity issues that have been dragging the neutral rate lower in the Fed's projections for the better part of the past decade, but it's been stable there for the last couple of years. And I think that could be a drag on an ongoing basis. But let's contrast that on the opposite side with what's happening cyclically here, right? The Fed is running monetary policy much easier than you'd expect for this point in the cycle, given its pivot to the FATE framework. And we're sitting here with the unemployment rate at 5.2% talking about tapering, when 6 years ago, the Fed was on the verge of raising rates at this rate. So I think cyclically, that's something that should bring more people back into the labor force, should raise trend growth rates to offset the demographic weakening, and probably keeps the longer run dot pretty much unchanged here. So without a doubt, the markets are pricing in about 100 basis points less tightening over this cycle than the neutral rate. But I think some of it's an expectation that the neutral rate may come down, but I think also some of it is that if the Fed has to go early in 2023, they may not need to tighten to 2.5% to actually slow the economy down, particularly if the concerns around COVID don't completely fade.